Good evening, everyone, and welcome to tonight's Strategy of the Week presentation titled Trading the Fast Lane. My name is Jerry D'Ambrosio, Senior Instructor with VectorVest, and it's my pleasure to present tonight's strategy for you this evening. Last week, Kathy Onan gave a fantastic presentation on a new concept that was developed by Dr. Barbara Starr. Dr. Starr developed a technique using dual bands and oscillators, specifically Bollinger Bands and the detrended price oscillator. We received a lot of very positive feedback on Kathy's presentation and this new technique, so we decided to take it a step further and try to come up with a trading plan using this technique. Let me first move into the software and review what Kathy presented last week. Let me move us from the home page. I'm going to click on Unisearch, and I'm going to scroll us down to the Pro Trader folder. Remember, this particular search, since it uses technical studies as parameters, it does require you to have the Pro Trader add-on module. We have included a link in the VectorVest views for you to sign up for a free 2-week trial. Now the search is called Star Search. I'm going to click on the original search here. And let me just close down this search directory. It looks for the stock's price to have a DPO crossover crossing above zero within the last 1 day, and it also looks at price crossing above the upper Bollinger Band within the last 2 days. Now we have some minimum price and volume requirements here too. The stocks have to be greater than $5 and the average volume has to be greater than 500,000 shares, and we're sorting by VST. And in the process of developing the trading plan that I'm about to show you, and we will move into the backtester to show you the research that I came up with. During that process, I found that eliminating all ETFs from this type of methodology worked a lot better than including them. So what we did is, you can see this search here, it says Star Search no ETFs. Now in your program tonight, you'll just see Star Search. I am recording this at about 2:15 Eastern Time, so the data has not been updated yet. The search in your program has not been updated yet, but again, it will tonight, and it will be the Star Search stock selection search with this one parameter added. It says stock sector not equal to ETFs. And that's the only parameter that I included. So before I move into the backtester, let me just recap what Kathy presented last week. I'm going to change our date here to the most recent DEW up signal on 5/22/2014, and I'll explain why I'm using the DEW a little bit later. I'll click on OK. I'll go ahead and run that search, and I'm just going to graph the top stock. I'm going to right click on Sanchez Energy, click on View Stock Graph. I'm going to change our graph from a 1-year graph to a 3-month and put the DEW signals on, and we can see where we found this stock. It was right here on 5/22. And again, just a recap from last week's presentation. And let me first explain what we're looking at here on the graph. Obviously the stock's price up at the top here in candlesticks. The white lines here, the white bands, are Bollinger Bands, and we're looking at a 20-day look-back period with a 1 standard deviation. The yellow lines, or the yellow bands, are also Bollinger Bands, same look-back period, but we've widened the standard deviation from 1 to 3. At the bottom is a 20-day DPO in blue and a 9-day DPO in yellow, and I'll explain why we put the 9 on there in a minute. So the reason why we found this stock on the 22nd of May is because the price of the stock crossed that upper 1 standard deviation band, and the DPO went from negative to positive, so it went from bearish to bullish. That's the trigger here with this scan. Now the concept behind this scan, or this technique, is that you want to make sure not only is price crossing above that upper 1 standard deviation band, but it then continues to rise and ride either the 3 standard deviation band or just rides that 1 standard deviation band and remains in what we call the fast lane. So Kathy used the analogy of driving a car down the highway, and if you feel that you need to go faster than everybody else, you're going to stay in that left lane. You're going to stay in the passing lane or the fast lane. The middle lane is a little more slower of a lane, and then the right lane obviously is the exit lane sometimes, or just the slower lane. So ideally you want to see price remaining in the fast lane, and you can see it did. So there was a lot of opportunity here to profit from this breakout. Kathy also talked about possible exits once price starts to break down. It's not going to keep riding these upper bands forever, so price eventually starts to break down here. On the 24th of June, it crosses lanes, it switches lanes. It goes from the fast lane to the middle lane. It starts riding that upper band, but remaining below that band, and eventually on July 1st, price of the stock crosses into the middle lane, and the 9-period DPO goes from bullish to bearish. So Kathy did again talk about how this could be a possible exit for you using this technique. Now, without using the DPO, if you're just looking at price, once price really starts to break down and switches lanes once again, again, I call that the exit lane, right? The right lane is usually the lane that you're going to stay in to exit the highway, and I think it goes the same for here as well. Once price crosses into that right lane, you really want to start taking action, exiting the position, taking profits at that point. So that's the technique. It's a great technique. And again, we got a tremendous amount of feedback using this technique. But really one of the things that we're missing here is a mechanical approach to trading this new search. You very well can run the search, take a look at the graphs. Obviously, this would be the entry. You would have to continue to open up the stocks graphs that you purchase and see when certain things happening. See when the 9-period DPO goes from bullish to bearish. See when the stock's price starts to switch lanes. You can do that visually, but we have the tools that make it a little bit easier on your part. One of the things that this technique is missing is a market timer, right? We always want to know when the market is rising so that we can implement a technique like this, and also when the market is falling so we can continue to manage our positions and not replace. So in the research that I conducted, of course, I used the backtester to do this. So let me close out of this graph and move into the backtester and show you what I came up with. I'm going to click on backtester here. All right, so you can see the search, star search. I used a 10% trailing stop. Now I did try multiple stop combinations, percentage gain losses, different types of trailing stops, average true range as well. So I tried a multitude of different stop combinations, and a 10% trailing stop worked the best. I also ran that 10% trailing stop on all of our market timing signals, and ironically enough, our technical study market timing system did the best, the DEW. It does use the detrended price oscillator in its timing model, so it kind of made sense to me that this market timer would work best. Again, I tried it using the confirm calls, the RT combo, just going long the entire time, but this one worked out the best. I went back to the beginning or the end of 2012, roughly the beginning of 2013, brought it all the way to current. You could see, not bad, 52% gain, 70% winning trades. Not many trades made. Your commission was only $348. That's an annual rate of return of 32%. But what I like about this, and one of the biggest factors for me in a trading plan that I would want to use, is the drawdown. Only a 7% drawdown here, maximum drawdown. So that's great. 32% annualized, 7% drawdown, 70% winning trades. If I go to reports, go to the situational summary report. Now it's here where we can compare this trading system with the overall market. VectorVest Composite went up 18% on an annual basis over that same time period. Calmar ratio of 4.25. So you're looking at roughly a 4-to-1 reward to risk ratio. Not many trades, only 20 trades total, 14 winners, 6 losers, and an 84% winning campaign percentage. Now there was 19 campaigns, which is from a DEW up to a down, that's one campaign. DEW down to the next up, that's another campaign. So we did very well here on a consistent basis. 16 winning campaigns, only 3 losing campaigns. And pretty nice equity curve here. So I ran this from the beginning of 2013, and I was very happy with the results. So I wanted to take it a little bit further. So what I did was I took it back to 2012, and the results were very similar. 61% winning trades, 88% gain, just about the same average annualized rate of return, and this drawdown was the same as well. So we're looking at almost a 3-year test bed here with this technique. 2012 started off very well, kind of flattened out, but ended the year of 2012 up nicely, about 25%. Ended the year of 2013 up 87%, and it's a little flat so far this year, but again, 88% total, 61% winning trades. If I go to reports, situational summary report, we could take a look at the same type of analysis we did with that 2-year test. VectorVest Composite annualized rate of return, only 16.5. We doubled that, up about 34%. A nice CalMAR ratio here as well at 4. Low maximum drawdown. 27 winning trades, 17 losing trades, 26 winning campaigns, and only 9 losing campaigns. I'll go ahead and close that. And anytime that we present a strategy like this or a trading plan, we're always going to provide the backtest settings in a PDF form in the VectorVest views. So you will see that link in the views for you to refer to. But if I just click on edit here, you can see our automation rules for our trading system. Using the DEW, we're using a 10% trailing stop. We're going to maintain 5 positions. I also found that 5 positions worked a lot better than 10 positions. We did automatically replace closed positions, and what I did was I took no action at the DEW down. During the course of my research yesterday and on Wednesday, I also tried to close all my positions at a down signal, but the performance when I did that suffered quite a bit. So just taking no action, letting your stop criteria take you out, not replacing positions, was found to be most effective. I'll click on cancel. So we feel that this is a fantastic technique. Kathy did a great job last week of presenting this technique and explaining it to you. We just felt that it was missing a few things, such as a market timing system to use and also a mechanical way to trade this system. If you're a chartist, if you don't mind looking at chart after chart every day, you can exit out of these positions using some of the techniques that we have shown you. When the price crosses from the fast lane to the middle lane, that could give you an early warning signal. When the 9-period DPO crosses from bullish to bearish, that's another trigger. And definitely when the price of the stock crosses from the middle lane to that right lane, to the exit lane, right? That should be your last line in the sand at that point. One last thing I want to do is I want to take this more recent test and I'm going to convert this into a portfolio, and I'm going to show you how you can start tracking this or trading this going forward. I'm going to right click on that line, I'm going to left click on convert to portfolio, and we're going to start with an empty portfolio. You can also continue from the end of the back test. That will take the current value with your 5 current holdings and create a portfolio and continue to track the performance of this methodology in the portfolio manager in the Genius. I'm going to start with an empty portfolio, and I'm also going to start with the portfolio Genius on. I'll click OK. Let's open the portfolio now. Okay, you can see that as of 2:30 p.m. today, the streaming automation has been enabled. But remember, we are in a DEW down situation, and I talked about that last night in the daily color guard report. We received a DEW down yesterday, so this portfolio will not trigger positions to be opened until we get a new DEW up situation. And of course, that is the best time to start. Any trading system or any methodology is at a fresh signal. You don't want to start a month or 2 months after, say, a DEW up. You want to start at that DEW up. And we found that throughout all of the research that we do, that is the best time to start something like this at a fresh signal. One last thing I want to make sure that everybody understands is this section here with the auto timer. It does require you to own the Auto Tester add-on module. The auto timer is a new feature to the Auto Tester. We've provided you with a link for a free 2-week trial in the VectorVest views, not only for the ProTrader add-on module, but for the auto timer as well. Well, this concludes tonight's Strategy of the Week presentation. Have a great weekend, everyone.